Good afternoon to everyone tuning in right now, and welcome to your FundSmart webinar series powered by First Metro Securities. This is your host, Cara from FirstMetroSec, and I, including the rest of the team, hope that you find this webinar helpful for whatever purpose it may serve. I'd like to welcome you all to the sixth episode of your FundSmart webinar series, and this time we have teamed up again with our FundSmart partner, Sun Life Asset Management, or SLAMCI. Now, for those of you who are unfamiliar and have yet to explore their first MetroSec accounts, FundSmart is our online mutual funds platform, a facility which allows you to invest in over 40 peso and dollar-denominated mutual funds from the six leading fund houses in the country, which of course includes SLAMCI. You can find FundSmart on the upper right corner of your first MetroSec trading platform. And on FundSmart, you can also filter and sort out the various funds by its performance, risk profile, risk rating, fund type, currency, and the like for your convenience. Before handing over the mic to our speaker this afternoon, we would like to take this moment to remind everyone that you can send in your questions at any time through the side panel provided if you're on your computers, or you can swipe left if you're watching this webinar through the app on your mobile phones. We will do our best to accommodate these questions later. We are also encouraging everyone tuned in right now to download the available SLAMCI materials about their various funds, such as the primer and the fund fact sheet through the handout section of the side panel. This will give you a better picture of our topic this afternoon. And again, SLAMCI funds are available to you online through FundSmart with no sales load. We also have for our giveaway later 3 SLAMCI umbrellas and 3,000 pesos worth of investment credits to be invested in any SLAMCI fund. So we hope you guys stick around till the very end of this episode to be able to qualify. We're also inviting you to join our official Facebook community if you're not yet a member. Just type in www.facebook.com/groups/FirstMetroSec, or you can also search FirstMetroSec official community on Facebook. Don't forget to also like and follow the official Facebook page of Sun Life to get their latest updates at www.facebook.com/sunlifeph or visit their website at www.sunlife.com.ph. In the previous episodes of our FundSmart webinar series, we have tackled on a wide horizon of topics on investing. But today, in our second episode with SLAMCI, we will be tackling on the next step of our investing journey. That is being prepared on what rewards and risks lie ahead, after laying out the foundation during our last episode with SLAMCI as well. Indeed, this is a very substantial topic, especially for our viewers out there who are just getting started on their journey. And we will get to learn all of these from the head of agency sales of SLAMCI himself, Mr. Gerald Bautista. Mr. Gerald Bautista, or GB, joined the company in 2008 and has been in the mutual fund industry for more than a decade. Prior to joining the financial sector, he served a short stint with the government under the Foreign Service Institute, Department of Foreign Affairs, as the research assistant. Thereafter, he joined the industry as a business development officer and subsequently handled institutional sales for an asset management company. He then moved to the banking industry with Standard Chartered Bank, handling trust marketing functions, as well as product management, handling various financial instruments, including mutual funds, structured notes, time deposits, and bank assurance products. He's a graduate from the De La Salle University, Manila, with a Bachelor of Arts degree in Political Science, and he took his higher education at Oxford Brookes University Business School in Oxford, United Kingdom, where he obtained a master's degree in business administration, focusing on global marketing strategy. And now, without further ado, the main act and our main guy for today, please welcome SLAMCI's head of agency sales for bank and alternative distribution channels, Mr. Gerald Bautista. Sir GB.
Right. Thank you, Cara. Good afternoon, everyone. Today is going to be an interesting webinar. First and foremost, we have a lot of things to discuss. Just get into the slides here. So the objectives that we have are quite interesting. Something really Very, very useful for, I guess, first-time investors or investors who'd like to recalibrate their investment strategies or portfolio, or have another perspective or mindset in terms of how they would manage their funds. So basically, this would be best for the newbie investor or for investors that are pretty much starting and would like to have more thorough understanding of their investments. So first and foremost, what you see here on the screen is basically the topics that we will be discussing today. Obviously, the most important thing, and this is really the more prudent approach in understanding your investment. What are the risks associated in investing? We have to understand the risk on diversification, why we need to diversify. We will talk about the concepts of diversification. Types of investment, we need to know the types of investments or the type of funds that we are invested in, and the investing styles. How do we execute our investing strategies according to your portfolio type? So these are, I guess, the salient points that we'll be discussing today. Okay, so risk is very, very important. Risk is basically related to some of the uncertainties that we have in life. There's an old adage that says the only things that are certain in life are death and taxes. But when it comes to a lot of financial instruments out there, in particular, or even real assets for that matter, there are a lot of inherent risks that we have to understand. And the key there is to understand. By understanding, we get to know the opportunities that we can partake, as well as the risk return payoff that we will establish as we go through the course of our investment strategies and investment assets that we own. Okay, there are a lot of risks associated with investing, and I'll try to make this as layman as it can be, and more, I guess, direct to the point or succinct, and in terms of knowing what are these risks. Easily, I mean, if you want to know more about the details of this risk, Investopedia is a good reference point to deep dive on this kind of risk. But I'd like to make it more relatable to you guys, as if we're talking on the street in terms of what's happening in the investment instruments that you currently own. Okay. First, I guess, foreign investment risk. There are some funds out there that are invested globally, so we have to know also the investment or global investment risk that we have exposures in. Foreign investment risk can also, I guess, be related to foreign exchange risk, if in any case there are hedging concerns in terms of how you manage your funds. So foreign investment is basically looking beyond the local or onshore products that you have and what's out there. So typically there are funds that are invested in fund of funds or feeder funds that are invested in other instruments globally. So again, we have to understand the foreign underlying risk associated to the fund. Basically, that would be political risk in that particular country, geographic region, or what have you. We also need to understand the business risk exposed to those kind of offshore exposures that we have. On the fund manager risk, obviously there are a lot of asset management companies here in the Philippines as well as abroad. Each have their own, I guess, core competencies or value-added services. Some are actually more aggressive, some are actually prudent, some are just in between. So we have to know which type of fund manager is best suited to your risk profile. Geographic risk is also kind of similar to the offshore risk that we were talking about a while ago. So there are some funds that are particularly focused on, let's say, Asia-Pacific, Asia-centric funds. There are European-centric funds. There are U.S., majority of which are invested in U.S. funds. So geographic risk is basically looking at geographic sectors across the world. Interest rate risk. This would be more, I guess, applicable to the bond funds or to the fixed income funds. It has a strong correlation to the price of the fund. So meaning if interest rates go down, tendency is that the net asset value per share or the price of the fund will go up. Or if the interest rate would go down, would go up, similarly, it would be on the opposite direction. So those are basically the interest rate risks that you would have to know in terms of what's happening in your fixed income portfolio or in your bond funds. There's a inverse correlation between interest rate and price movements of those underlying exposures. Later, I can probably deep dive more about interest rate risk as we discuss about bond funds. Large transaction risk, these are primarily meant for single investor risk, meaning if there's a big chunk of investors that came into the fund and then there's a need for that big investor to pull out. Typically, most of the funds that we have has a 5% liquidity requirement that's mandated by the SEC. So what does it mean? It means that all of the funds should have at least cash or cash equivalents in its fund to satisfy redemptions. So if there's a big chunk of investor that holds 10% of the total fund, then there might be a risk that the liquidity portion of the fund might not be sufficient. Market risk, on the other hand, would be pretty much your exposure to different markets. This is much relatable to the equity or index funds or balance fund that we have that are exposed to, in particular, the stock market. So that's one risk associated for those kind of funds. Of course, funds are not guaranteed. By law, we cannot. The returns of the funds are not guaranteed. We cannot guarantee it because that's a SEC mandate. But case in point would be what would be the pros for that. Whatever the fund earns, we give that in full. So we're not a spread-based institution that we give you a guarantee and then we take out a certain margin and then we only give you what is promised. So there's no guarantee into the funds. So whatever the fund earns, you get that in full. It's not insured by the PDIC, primarily because again we're not regulated by the central bank. We're regulated by the SEC, and in terms of insurance, there's no insurance in terms of like the PDIC insurance. There's no insurance on a particular investment amount in the funds. However, in terms of having some sort of ownership into the fund, since mutual funds are classified as shares, then you have actual ownerships into the funds that you own. So you have voting rights for that matter. Regulatory risk would be risks that are involved in terms of who's regulating the fund. So in this case, it's actually SEC. So there would be any changes on the tax policies, accounting policies or standards, or policies related to how funds are managed, then it would have a direct impact onto how funds are being managed as well. Underlying fund risk, these are very typical for equity or balance funds that has a fund of fund feature, meaning within the mutual fund, there are other mutual funds that it is invested at, or feeder fund for that matter. So there are funds out there that mirrors another mutual fund. These are the underlying investment risks that you have to know. So you have to kind of deep dive as to what particular mutual fund that are invested in other mutual funds as an underlying instrument. So you have to deep dive. So, but just to have some sort of comfort in the underlying risk, rest assured that all of the underlying securities or investments in mutual funds, you have the right to know where it's invested at. That's one of your rights as a shareholder, to ask the fund manager or to ask your relationship managers where these funds are invested at, and usually you would have a full disclosure on a periodic basis, whether it would be monthly or quarterly basis, that you get to see the fund fact sheets of these funds, and the fund fact sheets would give you that information as to where the funds are invested at in terms of the underlying securities. So that's it for risk. And again, it's very, very important to know the risk side of things when it comes to investing the fund of your choice. Diversification. So this is very, very critical. Diversification is basically a risk management strategy. Why is it a critical success factor in terms of managing your money? You need it. You need it because you have to know how to compartmentalize your money. If you need it for cash requirements, if you need it for long term, if you need it for short term, do you need it for certain life goals? Do you need it for other I guess investment objectives? So typically you don't put all your eggs in one basket as what they say. So if you have if you have, let's say, for example, a life goal, let's say you want to build a house, you want to buy a car, you want to have that next best trip to Europe, it's very, very prudent that you don't put all your money, your savings into one particular fund. You have to compartmentalize your investment needs, and knowing those investment needs, you match it with your risk profile, and you match that risk profile to the fund of your choice, just to make sure that there's a structured approach. And when you do that, that's in essence diversification in process. Okay. There are many tricks to how to diversify your portfolio. By one of which would be asset class. That would be knowing the different fund categories. Asset class means that you can put your money in money market funds, in bond funds or fixed income funds, in balance funds, or in equity funds. So later on, we can discuss more about diversification in terms of asset class. Management style. So there are funds out there that can be a passive style of management or an active style of fund management. These are typically your index fund portfolios that are quite passive, and there are active funds that are, regularly on a daily basis. The fund managers recalibrate their portfolio according to the investment objectives of the particular fund. So that's one factor to consider when it comes to diversifying your portfolio. You want it passive or active. By location, of course, if you most of the funds that we have are onshore. Onshore meaning these are funds that are invested in securities within the Philippines. But if you want to go offshore, then you will have to broaden your approach. So if you want to bridge the gap in terms of getting opportunities to be exposed in other geographic regions or in other global sectors or in other mutual funds abroad, then there are particular fund solutions for that. For one, this is the Sun Life products that we have in the dollars landscape. So we have a lot of dollar fund of funds that are invested abroad that would give you that instant diversification of investing in global assets. For the sector, of course, this would be very, very typical for the equity lace funds. So you have to know which kind of sector exposures that you're invested in. So sectors, of course, that would basically be sector exposures in holding firms, in property firms, utilities, etc. So the sectors, easily you can identify them as you look at the stock market components and the sectors that it represents. Okay. What are the types of investments in terms of asset class? I guess this is one of the, just springboarding from the diversify portfolio slide that we saw a while ago. Asset class is very, very important. So there are three salient asset classes in terms of, talking about mutual funds. One of which would be money market. Investing in money market has exposure to cash and cash equivalents. Ideally, this would be money meant for less than 1 year, or something that is for emergency fund. So if you have an emergency fund that you need, in 1 year or less, money market funds are ideal. But we've also seen some clients putting money in money market fund for more than 1 year. It depends again on the need that you have in mind. Bond funds are investments in fixed income instruments, mostly in government securities. There are bond funds that are also invested in corporate securities or corporate bonds. So knowing bond funds would be best for conservative investors because of the lesser fluctuations that it has in terms of its exposure into the fixed income market. Later, you'll have a better perspective as to how prices of the bond fund and money market performs as reflected into the fund. Equities, on the other hand, would be, of course, investments in publicly listed funds, right? Or for that matter, if you have a fund of fund equities mutual fund, then it can also be invested in mutual funds abroad. So equities is basically a claim into the asset of a corporation or that corporation that is listed in the stock market. Okay. So for the type of funds, money market fund. So as I've mentioned, money market fund is best for the low risk type of investor. If you look at the net asset value per share of the money market fund, or in terms of its movement, this chart best represents the money market fund that shows you lesser volatility. So what does it mean? The line chart that you see here is the movement of the price of the fund. In essence, you get to see that the price is constantly on an upward trend because it doesn't have the investment in it doesn't have that volatility component because it's mostly held into cash or cash equivalents or fixed income instruments that give you a steady rate of return for clients who are very, very conservative. In fact, for Sun Life, this is one of the best sellers that we have in terms of client appetite that is very, very conservative. So money market fund is ideal for clients who would like to shift their money from savings or time deposit and at the same time looking for higher yield. The year to date is around 2, but if you do check Bloomberg and if you want to check the annualized rate of return, or meaning the expected return for the money market fund after 1 year, pretty much it's doing around 4%. So for retail investor, if you have 50,000 pesos out there or a 10,000 pesos investment out there, a 4% yield, I think that would be very, very attractive. Normally, the 4% yield for 1 year in a money market fund that's mostly available for the high ticket sizes when you do talk to your back relationship managers. But money market fund, what's nice about money market fund, whether you're a 100 peso investor or a 1,000 investor or a 1 million investor, everybody gets the same rate of return. There's no preferred tiering in terms of your investment amount and the return that you are expected to have. So money market fund, very, very ideal for conservative investor. It's a good parking facility as well. So if you are trading stocks with FundSmart, and if you want to park it and monitor the market, and then you want to refund your stock purchase or your mutual fund purchase, you make money work for you by parking your money in a money market fund. So there's never a day that your money sleeps when you put money in a money market fund. Okay. For bond fund, it's meant for moderate type of investors. So it's mostly invested in debt incomes instruments or fixed income instruments that are invested in government securities or in corporate securities as well. If you notice, this would be your bond fund chart. So this is the movement again of the price or the net asset value per share. There's a bit of volatility into it, as I mentioned a while ago, in terms of knowing the risk. There is interest rate risk here. So if interest rate in the market goes up or down, the prices of the bond fund follow suits or reflects the movement of the interest rate that you have in the market. But the volatility is much more tempered than investing in equity-based funds. With bond fund, you get with additional risk. Of course, you would expect additional return. So if you're seeing 2% year to date, or for the money market fund, you're seeing 2% for 6 months, and then for the bond fund year to date, it's doing around 7% for 6 months. Then obviously you're looking at interest rate movements, and I think from what we know of, with BSP cutting down interest rate 3 more times, as the bond or as the interest rate would go down, as interest rate cuts, our exposure in this kind of instruments tendency is that the price movement will go up. So again, that's one of the things that you need to learn about bond funds. When interest rate goes down, your bond prices goes up. And inversely, so if you correlate it into the opposite side of things, when the interest rate do reverse. So this would be typical for clients who are very, very moderate in nature in terms of managing their funds, or in terms of having their funds being managed. So balance fund is again for moderate type of investor. because you have a portion invested in fixed income instruments, just like the bond fund, and the other half would be invested in equities or securities. So if you're going to look at the chart, the NAVPS, the volatility is much more pronounced because portion of the balance fund has exposures in the stock market. So if you're going to look at a bit of a kicker in terms of your moderate type of investment profile, then your kicker will really come from the equity component of the balance fund. So year to date, as of June, it's doing close to around 7%. Again, this is a balance fund, so a portion of which would be invested in equities and a portion would be invested in fixed income instruments, just like the bond fund. Ideally, for the balance fund, if you're going to look at the returns, the 7 and 5 to 10 years would be the best advice investment horizon for clients who are putting money in the balance fund. So it's pretty much meant for long-term hold or type of clients who would like to hold their money for a particular life goal or investment need. So the riskiest asset that we have would be the equity funds. So these are investments that are exposed to the stock market. So it has a very high risk component into it. So if you're going to look at the net asset value per share chart, this would be your price movement. So the price has actually, if you're going to look at it since inception, so from one peso, it has now gone up to more than four pesos. So since inception, it's done close to around 361% return. So the year to date is around 7.7%. Exposures in an equity fund has more, meaning it can be invested as much as 95% in the Philippine stock market, or if it's an index fund, it can be invested as much as 100% in the Philippine stock index. So your equity fund is ideal for clients who are very, very risk. Usually for investors like for the equity fund, they tend to be more long in their investment horizon. So 5 to 7 or 10 years would be the best advice to hold on to your fund when it comes to equity funds. So this now that you've known the risk side of things, the risk return payoff, the different asset class, now how do we compartmentalize that in terms of your risk profile? So here you see different risk profile. Risk profile would be basically how do you classify yourself? Are you a conservative investor or a balanced investor? In between that, you will be a moderate investor. And then from balanced to aggressive, there would be a range. So are you a growth investor or are you aggressive investor? So the funds that you see down there are the funds that Sun Life can do offer for you. So for conservative investor, this would be the money market fund or dollar starter fund. So again, these are for clients who are very, very conservative. If you want to start, putting your money from the bank and shifting it to mutual funds, and you're a newbie investor, you want to start trying the funds and how it's being managed for you by the fund manager, this would be a good starter for you since you're a conservative investor trying into mutual funds for the first time. But if you have a bit of exposure into the stock market, and if you want to have someone managing your stock market exposure, then the balanced fund or an aggressive or growth funds would be best for you. So here you have the funds that Sun Life manages in terms of what we can offer for clients. Then we also have, of course, moderate investor that are invested in fixed income bond funds, fixed income instruments, or funds that are invested in bond funds. So if you notice here, most of the pesos that we have, peso funds that we have, there's a dollar equivalent to those asset classes. So we get to satisfy the different ranges of funds, and we get whether it would be peso or dollar, and we get to satisfy the different investment profile for both peso or dollar clients. Now that you know the risk and reward component into it, as you've seen the returns of our funds, in terms of execution, here are the things that we can actually give you a bit of a perspective in terms of knowing your investment style. We're gonna discuss, of course, buy when the prices are low and sell when the prices are high. You get to learn more about active and passive management, the concept between lump sum or peso cost averaging and the perfect portfolio asset allocation approach, depending on your investment horizon or in your investment need. So buy low and sell high. It's when you buy into a fund or when you subscribe into a fund, you look at the NAVPS. That's net asset value per share. That's the price of the fund that you're getting into. So here, when you're getting into the fund, ideally you would like to see lower NAVPS if you're looking for discount prices. Why do I say so? The lower the NAVPS, so if you have an investment that has 50,000 pesos, and if the NAVPS is 2.8787, the number of shares that you will get is around 17,369 shares. So if you look at the denominator, if this NAVPS goes lower, equivalent to that in terms of number share, expectedly you would see your shares to grow higher. So if you're gonna plainly look at it, as the NAVPS goes down, or the price goes down, the more shares that you get to purchase. Now, of course, selling high, obviously, as you have purchased your shares, so in this case, 17,000 shares, obviously you would like to see that price to appreciate. So you just simply multiply the shares that you own in terms of the price appreciation of the funds. So as they say, sell when it's high. You don't typically sell when it's a bottom. If NAVPS or the price of the funds do go down, then it's up to you whether you would want to buy more, or if you have a stop loss limit, depending on the decline of the price, then you can do so. But for the more, I guess, more seasoned investor, they buy more shares when the prices are going down. So if you want to know the proceeds, or I mean the profit that you've made, you just basically multiply the shares that you have times the net asset value per share. Then you will get to know your current investment. Okay, active and passive management. So when you look up into our equity funds, or in funds that are invested in or balance fund for that matter, it's also an active fund. No? But here, case in point, we use the sample of the equity fund. No? The equity fund is basically different from a Philippine stock index fund. The Sun Life Prosperity Philippine Stock Index Fund basically just mirrors the 30 top corporations listed in the stock market and the components in it. So whatever weight that you see of, let's say, SM or Ayala, we just basically mirror those weights. Whereas if it's an equity fund, we get to have that active component into it. What do I mean by that? We can go +3 or -3 into that particular stock exposure. So we don't necessarily mirror the fund. So if you want to go heavy on, let's say, SM, then we can add 3% more into our exposure into the fund. If we see, let's say, for example, it's not going to be a mining year, we can lessen our exposure up to -3 on that particular stock. So there's a flexibility in an active managed fund, +or-3 in our exposure per stock. Whereas if it's an index fund, we just purely recalibrate our portfolio and mirror what the PSE components have. So that's in a nutshell, that would be your active and passive management. And in terms of giving actual samples into the funds that we manage. So here's the more interesting part of our discussion: lump sum versus cost averaging. So lump sum is basically one-time placement into the fund. So it's a single fund purchase. So you only look at one price, and the shares doesn't change because you've only invested one time. But of course, when you invest in a lump sum, prices change daily. But if you want to take advantage of those daily changes in the fund, then you would want to partake in a cost averaging strategy. So cost averaging is putting money successively or automatically. You are invested into the fund by having multiple investments. You get to take advantage of various fund prices. So as I mentioned a while ago, as they say, nobody can predict the market movement. But with cost averaging, if you want to catch base if you want to catch certain price positions or price fluctuations in the fund, especially if the fund are correcting and going down in its price, then obviously you get to buy more shares. That's your typical cost averaging type of strategy. So you don't necessarily have that much, I guess, indifference whether the prices go up or down. You just, the primary concern, the primary perspective there is to actually just have multiple investment and let the shares accumulate over time, as opposed to putting it in lump sum. So to best describe it, or to best illustrate the difference between lump sum or cost averaging, I think this is an actual price movement of our, if I'm not mistaken, a balanced fund. So here in April 2013 into April 2015, that's roughly around 2 years. So a lump sum sample of an investment strategy, let's say, for example, for this client, the client put in one time 25,000 pesos. So the client came in at 4 peso 17 centavo and 4.1779. That was the price of the, let's say, for the balance fund. And the client bought 5,984 shares. Again, this is not cost averaging. So if you look at the yellow bar chart, it shows that the shares of this client purchase is stagnant. It didn't change because there was no redemption or additional investment into the fund. This client just basically owned 5,900 shares without taking advantage of dips in the market. As you see, the blue line here shows you a dip into the price or a dip into the market as it rebounds. So in this case, the client initially purchased the fund at 4 peso 4.1779, and then after 2 years, as the fund rebounded or the market rebounded, it went up to 4.2195. But since the shares did not change, your exit would be dependent on the price of the fund when you exit. So in this case, you just multiply 5,984 times 4.2195, and then you get to see a capital gain of around 25,249 pesos, or an ROI of 1%. So this is a lump sum sample. Of course, it's different if the fund is, let's say, a money market fund, whereby the price of the fund just continually goes up, right? But if you're going to look at cost averaging in terms of, again, let's say investing in equity-based funds, it will be different, as opposed to lump sum. So here, the same price. So the client went in, not lump sum 25,000, but 1,000 pesos for 25 months. So here, if you will see, for 4.1779, the client was able to buy 239 shares. It's the same NAVPS movement, or the same blue line movement, but in this case, you will see a different a correlation whereby when the price goes down, your shares, the shares purchase that you have goes up, again because of the discounted value of the fund. As we say, as the price goes down, the more shares that you purchase. So again, this is ideal for clients who cannot time the market, but if you have that auto investment perspective into it, whereby on a monthly basis you just put little amount of money to take advantage of dips in the market, then best cost averaging is best suited for you in terms of getting more shares out of your purchase. In this case, as opposed to the lump sum, this client was able to accumulate 6,430 shares, as opposed to the 5,900 shares that the lump sum client put in. Same NAVPS of exit. So you just multiply the 6,430 shares to your NAVPS of exit, which is at 4.2195. Here you see a difference in terms of its capital gain. A while ago for lump sum, it was 25,249. In this case, you see a 2,000 pesos different. So this is 27,130 for the shares that you have accumulated over a period of 2 years in this case. So an ROI is much, much higher as opposed to having lump sum. But again, this would be, best cost averaging would be best if you would ask me personally. Cost averaging is best for market that has a lot of volatility moving forward. If there are dips in the markets and if there's rebounds in the markets, but you'll never know what will happen next. Just to ascertain that you want to accumulate more shares, then best cost averaging would be best for you, especially when you see market corrections moving forward. Lastly, I think this would be our last slide. So looking at your portfolio asset allocation approach, again, this is a mix of diversification, a mix of the investor profile that you have, and a mix of all the fund categories or asset classes that we mentioned today. So if you're a conservative investor with a low return, with low risk exposure or low risk expectation, ideally you would want to have a diversification approach, and by that you look at the conservative or moderate type of asset allocation approach. In this case, if you're moderate or aggressive, you have more exposure in bonds or fixed income instruments, and that doesn't limit you to putting money in money market fund, of course. Balanced fund, growth, and aggressive would have more exposure, or for the balanced fund, it's 50-50. But if you're a growth or aggressive type of investor, then that asset allocation approach of having more exposure in stocks or in equities is best suited for you, with the fact that you have higher risk tolerance to get that higher return as you hold onto your fund, depending on your investment horizon. So that's it for our discussion. I do hope that you learned a thing or two. I think we're going to open the floor for Q&A, and I guess the floor is open for the Q&A.
All right, thank you for that very insightful discussion, Sir GB. I'm sure everyone who tuned in took away vital learnings, especially keeping in mind that investing isn't just about rewards, but also the importance of managing the risks that it entails. Hopefully, you guys have an idea now on how to go about in taking the next step towards your financial goals through the strategies shared by Sir GB. Now, before we get to our Q&A segment, I would just like to remind everyone that who is not yet a member to join our growing Facebook community. You may just proceed to www.facebook.com/group/FirstMetroSec or search FirstMetroSec official community on Facebook. And also, please don't forget to like and follow the official Facebook page of SLAMCI to get their latest updates at www.facebook.com/sunlifeph or visit their website for more information. Heading on to the next part of today's webisode, the Q&A. Again, we're encouraging everyone tuned in today to send in your questions or anything that you are curious about investing, or perhaps the various Sun Life funds that you are curious about. Let's take advantage of the opportunity being graced today by an industry expert like Sir GB, so keep those questions coming. So are you ready, sir?
Sure, go.
Okay,
Yeah.
I love the energy, sir.
Yeah.
Let's start with some questions which were sent via email. Hi, sir, I have recently invested in this SLP MMF, so I guess that's the Sun Life Prosperity Money Market Fund. They say it's for short-term investment only. Do you advise focusing on just one mutual money market fund or two or more?
Okay. Money market fund is best for clients who are conservative and they have an investment objective that is meant well, usually placing money in money market fund is there are two things. You use it as for cash emergency fund, as an emergency fund, or your cash fund, or a fund that would be looking for higher yields than your typical time deposit or savings account. So those are the typical investor profile that we get from money market fund. But buying more money market funds is also okay. I mean, that's a way of diversification of your. That's that's diversifying your fund management risk. So if you're looking at other money market funds out there and how they manage their money market funds, that's okay as well. So it's actually quite prudent to diversify your portfolio with various fund managers. But if you're looking for more return, then obviously your risk appetite should be higher as well. In that regard, then you would have to consider the other funds that you have to think about, and how does it match to your investment objectives. Is it for a specific life goal? Is it for an emergency fund purpose? Then you have to have that perspective in terms of knowing why are you putting money in that fund, and what's the reason, and what would be your expected investment horizon, or the number of years that, or the number of months or years that you're willing to hold into the fund, and of course the risk return expectations. So if I answer your question right, diversifying in other money market funds, that's also okay. You're basically looking at other fund management capabilities out there on how they manage the conservative fund.
All right, thank you for that, Sir GB. We have another question here sent through email. Is there a needed training when it comes to investing in mutual funds, like what we do like it does in stocks?
Well, I think you guys can offer also trainings, right, for walk-in investors. So FirstMetroSec has, they usually have periodic mutual fund orientation seminars. You can attend their forums, their open forums. I think this is this is not a webinar; it's a face-to-face event, so you can attend to those. Webinar series like this also helps knowing more about the mutual fund business. If you check YouTube, there are a lot of references when it comes to understanding what mutual funds are. So there are a lot of materials. There are a lot of educational touch points that you can have in terms of knowing more about mutual funds, whether it would be digital, face-to-face, or webinar series like this.
All right, thank you for that, sir. So maybe we can start entertaining questions sent through the chat. We have one here. Why do you always have prosperity in the names of your mutual funds? Is there an etymology behind your fund names?
Well, of course, prosperity, it's basically like a branding in terms of it's our branding component when it comes to giving identity into Sun Life funds. So prosperity obviously is correlated to being prosperous, or a money tree that continuously grows, that gives clients a lot of, I guess, more returns. So there's not it's pretty much, I mean I'm going in circles here, but it's more of a branding consideration more than anything else. And we want the prosperity to resonate to our investors, because at the end of the day, we still want to have that prudent approach in managing our funds, but at the same time making sure that for your particular investment needs, we give you the risk return expectations that you have for those fund of choice that you bought.
Nice. Beautiful answer, sir. Okay, another question. Do bond funds work like compounding interests, or is it based on the performance of the market?
It's based on the performance of the market. So on a daily basis, the funds actually do change in terms of its price. So the bond funds have lesser, it has volatility, but it's invested in interest rate. So the price of the fund will change based on the interest rate market that you have in where we're exposed at. In this case, if it's a peso bond fund, then we're exposed to interest rate risk. But if it's a dollar-denominated bond fund, then and then if it's invested in offshore funds that has fixed income and component in mutual funds abroad, then there's interest rate risk that are outside the Philippines. So it's dependent on the underlying securities. It's not per se compounding. It depends on the price of the fund.
Thank you for that, sir. Next question we have here. Are there any advantages in getting mutual funds through Sun Life's financial advisor rather than various fund markets like FirstMetroSec?
Yeah, good question. So for fundSmart, it's a do-it-yourself type of initiative. So meaning whatever mutual fund references that you see in their website, then it's really up to you. You do your own education, but of course, I think they can guide them with in terms of the fund, I guess, references that they post in their website, as well as fund recommendation. But with an advisor, of course, if you want that advisor relationship or that human touch point, and you want to know more about having that conversation of, to, let's say, for example, portfolio diversification that matches your life goals, then there needs to be a thorough, discussion on that. If you want to have a deeper discussion and an advisory level type of experience. So investing in, again, do-it-yourself type of experience through FundSmart is one thing, versus that of looking for that face-to-face touch point that has more discussion, that human touch, that human interaction, that gives you a bit of course, advice as well. That's why they're financial advisors. They give you a discussion point as to how does this match your life goals. Do I change? How do I need, if I need a relationship manager that goes through the process of that change. Whereas from your end, if it's a do it yourself, then you have to be quite cognizant as to how you would want to recalibrate your portfolio. If you want to add more, that all depends on you.
Thank you for that, sir. Another question. What's the minimum time frame of money market funds?
Okay, this is quite interesting because most of the Filipinos, as you know, sometimes long term for them. I mean, if they have your savings account or time deposit, we've seen a lot of Filipinos putting money in a savings account or a time deposit and not touching it for 5 or 10 years. The common mistake is that if you have money meant for 5 or 10 years, then you have to look for an investment vehicle or a fund that would match that 5-year, 10-year horizon with a 5-year or 10-year return. Money market fund, as you've seen it, it's quite conservative. It for let's say for 6 months from January to June, it has yielded around 2%. Of course, if you put money in equity funds, you can lose your money, but at the same time, you can get more than 10% in 6 months. Of course, that depends on the market movement, right? So money market fund, ideally, it's really meant for short-term placements, especially if you have cash components or for funds that are meant for emergency. Then it would be your, well, the money market fund, the holding period is just 7 days. So meaning after 7 days, you can withdraw it anytime, whether that would be, on the 10th day, 6 months, or 1 year from now. So there's no particular time frame, but as a prudent approach, putting money in money market fund is okay, as long as there's an investment rationale as to why you're putting it there for that particular time horizon. Because if you need that liquidity in the next 1 year or 2 years, money market fund would be best for you. Say, for example, if you're accumulating money to buy a particular property and you just want it there without, parked in a money market fund without experiencing volatility, then that would be the best fund for you. But if it's meant for life goals, that is for the next 5, 10 years, 15 years down the road, of course, most of our life goals change as well. I mean, case in point, if you're going to look at, if you have a life goal, I'm just putting samples here. So if you have a life goal of getting married in the next 5 years, from what I know of, references say wedding expenses go up 15% every year. So if you just park your money in money market fund, and if you expect to get married after 5 years, but that money market fund is just yielding you around 4% every year, but wedding expenses go up 15%. So how do you actually catch up to the cost of inflation or appreciation of your wedding goal? So if you have goals that are meant for long term, again, look for an investment vehicle that would give you a long-term rate of return. Of course, accepting the risk return considerations when you match it for that life goal.
Thank you for that, Sir GB. I guess we have time for around 2 more questions. Would that
Okay.
be okay? All right. So the next question we have here. If I invest in mutual fund aggressively long term, will I get guaranteed more returns?
No, you cannot. By again by law, by SEC uh, regulations, we cannot guarantee our funds. So whatever the fund earns, we give that in full. Um, well, for aggressive long-term funds, so top of mind, let's say for example, if it's an index fund, references say if you check Bloomberg, if you check your reference points, investing in equity funds, if I'm not mistaken, for the past 10 years, it has yielded around close to 270% if you stay there for 10 years. That would be your aggressive approach long term with an aggressive return. But then again, the return depends on how the stock market will perform over that period of years. So whatever the fund earns, we give that in full. We cannot give a specific guarantee.
Thank you for that, sir. And now, time for our last question. Which is better, investing into mutual funds or availing of the variable life insurances?
Okay. This question comes up very often.
Yeah.
Again, it depends. If you want a product that is meant for protection, then obviously the insurance type of investments, the insurance type of products would be the variable unit link products. It has a protection component into it, so anything happens to you, you get your face amount. Mutual funds is basically meant for clients who want to have complete exposure to the investment or to the underlying investment. Because if you're going to look at the VULs, there's a cost of insurance into it, meaning you're paying something for the protection that you need, for the insurance component that you need. Whereas if it's a mutual fund, the entire money that you put in is invested into the fund, and that fund is actually invested fully into the investment securities that it is exposed into. So there's no insurance component in mutual funds. That would be your primary difference. So think of it this way. So you put money, and if I'm going to put it in an analogy, insurance products are like elevators. If anything happens to you from ground floor, you go up to penthouse, because if anything happens to you, you get your protected, uh, I guess, feature into from the product. Whereas if it's a mutual fund, it's like, I would think, like an escalator or stairs. So wherever you stop, which is the price movement of the fund, you exit there. So that would be my best analogy when it comes to VUL or mutual funds. So again, for VUL, there's a protection component into it. There's an insurance cost of insurance component into it. Whereas if it's a mutual fund, your funds are fully invested into the fund that has you're fully invested into the fund and the underlying investment instruments that is exposed at.
All right, thank you for that, Sir GB. And that is it. Thank you, sir, for accommodating our questions for today and sharing with us your insights. Thank you as well to everyone who participated and sent in their questions. We sincerely apologize that we weren't able to entertain them all due to time constraints, but no worries, because we will still do our best to accommodate your questions through email. So if you're curious about the various SLAMCI funds or may it be FundSmart related, just feel free to send them in. And again, thank you, sir, for answering.
Thank you.
On to the next segment, everyone's most awaited part, our giveaway. This afternoon, we are giving away 3 of SLAMCI's exclusive tumblers and the grand prize, a 3,000 peso worth FundSmart investment certificate to be invested in any SLAMCI fund. Definitely the perfect avenue for you to channel your learnings from today. So here are the mechanics of our giveaway. Take a screenshot of the next stream, go over to your Facebook wall and post it along with a caption about your favorite part from today's webinar with SLAMCI. We are encouraging every one of you to get as creative as you want, share out your takeaways, and if you're feeling bold, you can even share your investing plans. We will be choosing 3 lucky winners for the tumblers, and the one with the best caption will win the investment credits. Just don't forget to make it public and tag us at First Metro Securities. We will contact the winners personally via Facebook. So if you guys are ready, please go ahead and take the screenshot now. And that is a wrap. Thank you so much to everyone who tuned in this afternoon. Head over to our calendar at www.firstmetrosec.com.ph under seminars, promos, and publication, and then calendar of seminars to view our upcoming webinars and seminars for you. Please don't forget to follow us on our social media channels. So if you're looking to stay up to date with our latest events, market news and updates, and everything in between. This has been your host, Cara, along with our speaker, Mr. Gerald Bautista of SLAMCI Mutual Funds. And as always, with First Metro Securities, it's